I think it is a trade in the economy, or at least worries about it, because I actually don't think certainly that there's reasons to worry too much about the economy yet. The trade's a tough one just because we really don't know how it plays out, and that's why, of course, every headline around China and the U.S. or a tweet about Tariff Man gets the markets moving.
Yeah, and I took some beef on Twitter because I put trade and the economy together, because most people we've talked to seem to agree that the trade issue, the trade tussle, whatever you want to call it, is an overhang on the macroeconomy. If somehow that gets removed in the next couple of weeks or months, we settle our differences, come up with some deal on China, back those tariffs off, Bill, do you expect the markets here and maybe there to recover?
I do, because I think when you really look at the actual current fundamentals, let's just use the ISM data from last week. If you use those, it says the U.S. is growing, we're, roughly at about it'd be consistent with about a 4% GDP growth rate. Probably not really hitting that, but certainly nowhere near any sort of recessionary numbers or anything that you need to worry about. So I do think that that's the big overhang.
Okay, it's also the Federal Reserve, right? So what does the Federal Reserve do now? Do they watch the equity markets? Do they watch the bond markets? And more importantly, do they change their thinking, or do they just keep raising rates?
Well, I think you've already seen it, right? You've seen some change from Chairman Powell, like eased off on that we're far away from the neutral rate. Now he says we're very close. The markets, and I think they told you that last week when I know we probably talked more about yield curves than we've talked as long as I can remember in this business. But certainly the front end of the curve told you, hey, the market's saying, whoa, up. You're getting towards the end of your hikes, and eventually actually pricing in that we're going to start easing sometime in 2021. I do think, and I know the Fed watches those yield curves because they write about them all the time. So I think they're watching that part. It won't stop them from raising rates here this month, but I think it may put the brakes on early next year, at least in terms of taking a pause. And I think the market's going to like that. I think at least for right now, as long as the Fed stays consistent with their comments that we're getting close to the end of hikes, or at least certainly going to pause and watch the data, I think that's actually a good part of the background.
You think that there's any, I know you're a longer-term investor, Bill, but hey, come on, we're approaching the holidays. You think there's any chance we get some kind of a relief rally?
I think so. I mean, certainly with the beating we took last week, I always kind of think of the market as a bit of a spring. So you've now compressed the spring again. If we get any sort of good news, usually you'll get at least a decent rally out of it. And I think too, think about the end of last week. At least we ended with the OPEC, making some better than expected, I guess you'll call it, production cuts, at least better if you want oil to go up a little bit, which I think is part of that signaling process. That's another part that's worrying, some part of market participants, that's signaling some sort of big decline in demand. I mean, the oil prices haven't come down. I don't think that's the case, but I think it's part of the backdrop.
Yeah,